Hello, you beautiful entrepreneurs. Welcome to this week's episode of Your Business Unleashed podcast. Today, I want to talk about the 2024 capital gains inclusion rate increases that were announced in the 2024 federal budget by the Liberal government. So this is going to impact a lot of people, a lot more than the Liberal government says that it's going to impact. They are taking numbers based on statistics for individuals who have capital gains over $250,000, and those may hang together for that very narrow purpose. But what they're not considering is everybody who's invested in a pension fund or everybody who's got investments in the public market through RRSPs or TFSAs. All of those people will also be impacted. And I think that it's quite a bit more people than what they're actually telling us. Of course, this is a very common practice for the Liberal government, is to sort of minimize the negative impacts of their tax policy. They've tried to, over the last year in particular, but over the last several years, tried to implement a tax policy which was less than ideal and hurt a lot more people than what they had originally anticipated. And I'm not sure why that happens. I can't explain that. But anyways, let's get into how does the 2024 capital gains inclusion rate impact you and your business. By the way, you can go and look at this on our blog. I've got this typed up so you can go and read it at your leisure. Mm-hmm. So what is the increase? So when you have a capital gain, either personally or in your business, half of it is taxed. There's a 50% inclusion rate on capital gains. And what that does, broadly speaking, is it motivates people to have capital gains instead of receive dividends. So when you go and invest money in a private company, for example, or in a building, and you go and sell it for an increase, that is a capital gain, and that's taxed at lower rates than if you bought a share of a company that pays dividends. And so policy objective here is to try and level the playing field a little bit, I'm presuming, to try and make it so that capital gains tax rates are more in line with dividend tax rates. And so what they've proposed to do in Budget 2024 is to raise the capital gains inclusion rate from 50% to 67%. Now, we don't have law yet, and there are so many things that are impacted in the Income Tax Act and everyday lives of entrepreneurs and ordinary Canadians that haven't been addressed in this announcement. And we don't yet, as of the date of recording this podcast, have any legislation to look at. But the changes are set to take effect in 20 days. So in 3 short weeks, the changes are going to take effect, even though we don't have law to review. And so what does that mean? Well, that means that a ton of Canadians right now are scrambling, trying to decide whether or not they should trigger capital gains early at the old rate, pre-June 25th, 2024, at 50% inclusion rate, or can they wait and do it after at 67%? And I have had a lot of clients come to me and ask me that question. And the answer that I give them most often is, I don't know. I don't have law to point at to do an analysis on your particular situation. So that's the capital gains inclusion rate. And so who's going to be impacted by the capital gains inclusion rate increase? This is going to be anyone, including wealthy investors, which is the stated target often by the Liberal government. They like to stick it to the wealthy because they don't pay enough tax when, by and large, they pay most of the tax in Canada. In fact, by a huge, huge margin, they pay most of the tax base in Canada. Not wealthy investors are also going to be impacted. If you invest in a stock or you invest in a pension plan, so you have a company pension or you have a TFSA or an RRSP and you're not wealthy, well, guess what? You're also going to be impacted. And why is that? Well, we'll talk about the exemption later, which means if you have capital gains up to a certain amount, you won't be impacted. But the companies that you're investing in certainly will be impacted because when they have a capital gain, they have no exemption. And that's going to change how much they're paying out to you as dividends or capital gains dividends or whatever. Any kind of distribution that you receive from your investments is presumably set to decrease because all of the companies that you're invested in through your TFSA, your RRSP, or your pension fund are going to have less money to play with because they're going to be paying more to the government. Okay, so everybody's impacted. So corporations that hold capital property. So for example, at Achen Henderson, I've got my office here. I've got some desks and furniture and chairs. Those aren't appreciating assets. But if I held IP, for example, a piece of software that I had developed, or maybe the building that we're sitting in, if it appreciates, we're going to be paying capital gains tax on that when we sell it. And so we are impacted as company owners. Owners of corporations, including small business owners, whether they make money or not, so like think plumbers and farmers, and shareholders of publicly traded companies, they're all going to be impacted. Anyone who owns a vacation property, inherited or otherwise, is going to be impacted. So this is going to be a very, very large number of Canadians that are impacted by this policy announcement. Okay, so let's talk about what the specific proposals in the 2024 budget are. So for individuals, the capital gains inclusion rate will stay at 50% on the first $250,000 of capital gains that they earn in a year, okay? And that's reduced by current year capital losses, previous year capital losses, and exemptions such as the lifetime capital gains exemption or the employee ownership trust exemption, which is proposed, the proposed Canadian Entrepreneurs Incentive. And then after you go over that $250,000, it's 67% thereafter. So I've had a lot of people calling me going, should I trigger my gains before June 25th? And my answer to them generally is, do you hold them personally? Yes. Well, how much gain do you have? Well, I've got $80,000 worth of gain. Well, those people aren't going to be as impacted by this because they've got a $250,000 personal exemption from the new inclusion rate. It's going to be 50% up into $250,000. So my answer is generally no. You don't need to preemptively trigger capital gains and prematurely pay tax. Now, if you're sitting on an investment account and you have $1 million unrealized capital gain, we should definitely take a look at that, okay? So for corporations and trusts, the capital gains inclusion rate will increase from 50 to 67% on the first dollar of capital gain. There is no $250,000 exemption as with individuals. This includes small business owners and companies that are not owned by ultra wealthy people. Simply because they took the risk of owning a company, they're now exposed to the higher capital gains inclusion rate, and they don't get the benefit of the same exemption that an other individual taxpayer would. And so this is actually, you're sticking it to entrepreneurs a little bit here, quite a lot here actually, for not having invested personally. You've gone and invested in your company. Well, your integration's broken. We're going to talk about that in a minute, the concept of integration. But you're basically saying because you chose to operate your small business in a corporation, whether you're making money or not, you don't have to be ultra wealthy. I deal with 90% of the business owners that I deal with are not wealthy. Okay, they're just trying to get by. And those people will all pay more tax than if they just operated as a proprietorship and invested personally. And I don't think that's fair at all. Okay, so, and there doesn't seem to be any grandfathering of unrealized capital gains, which were accrued before June 25th. The government has seemed to set up this idea that we need to trigger our gains by June 25th, which indicates to me that there's going to be no grandfathering, although I can't really say that because there's no legislation. And so there we are. So when does this become effective? June 25th. We got 3 weeks as of the date of this recording. I don't know when it'll hit, but it'll be pretty quick here. So how does the capital gains inclusion rate unfairly impact entrepreneurs who own corporations? I kind of hinted at this a bit earlier, but I'll go through it again. So there's no exemption in a Canadian-controlled private company, whether it makes a lot of money or not. So this is not an ultra-wealthy thing, as the Prime Minister continually likes to say over and over and over again, that catchphrase that catches a lot of unsuspecting voters off guard. So they don't have to go and do their research. If they just listen to the Prime Minister, yay, we're sticking it to the wealthy. I absolutely hate that because this isn't the wealthy that we're sticking it to. It's everybody who owns a corporation. So if owns a corporation and invests in it. If a business owner earns a $250,000 capital gain in their small business corporation, they will pay about $26,000 more in tax on that gain than a proprietor who didn't have a corporation. And that's not really fair, is it? There's no fairness there at all. And by the way, that's in Alberta, where our tax rates are relatively low compared to the rest of the country. In PEI, it goes up to 15%. You're going to pay $38,000 more on a $250,000 corporation $250,000 capital gain earned in a corporation compared to if it was owned individually. So our tax system has a concept called integration, which is a fairness concept, and it requires that income earned in a corporation and fully distributed to its shareholders should have the same amount of tax paid on it overall, corporate and personal, as if that shareholder had earned the income personally. This has been a bedrock in our tax system for a long time, ever since there's been a tax system, as far as I know. And integration isn't perfect in all provinces, but it's fairly close. And so the idea is if you earn $100 in a corporation, you pay a bit of corporate tax, you pay out a dividend. By the time the dollar hits your jeans at the top marginal rates, you should have about $52 hitting your jeans. Whereas if you earned $100 in the corporation, paid it out as a salary, you're going to pay no tax in the corporation, and you're going to pay at the top rates 48%, and you'll end up with about $52 in your jeans. The same thing applies to capital gains. If you have a $100 capital gain in your corporation, 50% of it is taxable, right? So you should pay about $24 in tax on that capital gain if it was earned in the corporation. And so by the time the dollar hits your jeans, you're going to have $76. And that's not true anymore with this new announcement. You're going to have less dollars in your jeans than $76, which is what you'd have if you earned it personally. So it's broken. The concept of integration is broken, and it causes what I'd like to call disintegration. It's unfair because a plumber or a farmer who's earned any capital gain in their small business corporation will pay substantially more than a wealthy individual who earned the same capital gain outside of corporation, as long as that capital gain is below $250,000. So we're actually saying to the wealthy individuals, the ones that can earn $250,000 a year in capital gains, go ahead and take advantage of the lower rate. But if you're a plumber who owns a small business corporation and you have a $10,000 capital gain in the corporation, you're going to pay this higher tax rate than the wealthy individual that I just talked about. That's not fair. Okay. So should you trigger capital gains before June 25th in order to save taxes? There's been so much written on this. You can go and look up great articles on it. Jamie Gollenbeck's done some great articles for CIBC. And there's been lots of good stuff put out by Jay Goodis, although it's more geared towards tax professionals. So unfortunately, with so many things in tax, the answer is it depends. For every individual and every corporation who's considering selling assets, you need to run the numbers for your particular circumstance in order to know if you would get a tax advantage from selling shares before or after June 25th. And we need to know your corporate structure. We need to know if there's a trust. And then to make things more confusing, there's an alternative minimum tax, which is a parallel tax calculation that runs beside the regular tax calculation. And big capital gains often trigger a minimum tax. Consider it sort of a fairness tax, I guess, is if you've earned a sufficient amount of income, you should pay a minimum amount of tax. And that's what the alternative minimum tax is. And that's changed a lot in the last couple of years. And so you have to run those numbers as well. So we've seen scenarios where the sale of a $2 million small business will attract less tax after June 25th, where selling an investment portfolio for the same amount could attract more after that date. The numbers are dramatically change at $3 million. Donations change the math. Capital dividend account balances change the math. Capital loss carryforwards change the math. It's extremely complicated, and you have to actually get into the specifics of it. And by the way, we have no legislation. So, we can guess all we want, but we don't actually know how these things are going to apply. So why does it matter that there's no legislation yet? Uncertainty, particularly in the realm of investing and creating jobs, is bad for business, and it makes it impossible to predict the outcomes of tax policy announcements. Okay, so there's several questions that tax advisors do not have answers to, making it impossible for us to properly advise our clients in the next 3 weeks. Right? Reserves. How do reserves work? So let's say you sold your company a couple years ago and you're claiming a reserve because you're getting paid over 3 or 5 years. Well, the sale happened 3 years ago, but you're getting paid into the future. So what about these future payments? Will they be taxed at the existing rates? We don't know. Right? So does that mean that you have to not claim any reserves this year and prepay a bunch of tax for money that you haven't yet received from the purchase of your company? Not sure. How about net capital loss carryforwards? We don't know if the loss carryforwards will be allocated and applied on gains earned before or after June 25th. Will there be an election to trigger a gain? Well, we're getting pretty close here, 3 weeks to go. So in order to trigger a gain personally, an individual has to go through some pretty fancy footwork, an individual has to go through some pretty fancy footwork if they want to, say, move their vacation property. They have to move that into a corp or into a different ownership structure and change land titles in order to trigger a gain. Well, why wouldn't the government just give us a tick box to say, you know what? I know you want a bunch of tax money because I know you've been running insane deficits for the last decade or 8 years. Just give me a box to check off so I can just prepay a bunch of tax without having to pay the lawyers and the accountants a ton of money to get this done, okay? Which is what's happening right now in order to trigger gains. For most middle-income Canadians, they can't afford to hire $450 an hour tax advisors and $650 an hour lawyers to get this done. That's not really fair either, particularly when we're 3 weeks from the deadline. Is there going to be a prorated exemption for 2024, or is the whole 250 going to be claimed and you're going to be able to claim the whole 250 in 2024, or is it just going to be half a year that you're going to be able to claim? I'm not sure. How about provincial tax? Quebec and Alberta administer their own tax programs. Are they going to follow suit? The Liberal government has a well-established history of backing down from its insane and ill thought out tax changes. Sometimes they do it at the very last minute. This started most notably back in 2017 with Trudeau and Bill Morneau's attack on private company owners, back when I went to Parliament and testified on this stuff. And it extends as recently to a few months ago when the government backed down from the underused housing tax deadlines and extended. And then the trust reporting rules, which got kicked down the road for several years. And then they were supposed to happen on March 31st. And then, a little bit before the deadline, they went, don't worry about it. And this is after people have paid us thousands of dollars to figure this stuff out and get compliant on this. Sorry, I'm a little bit hot on this, if you can't tell, because it's insane that the government would do this to its citizens. And this is the uncertainty that I'm talking about. This is not the characteristics of a professional G7 nations tax policy deployment. This is not what should be happening. This is a ton of uncertainty. And by the way, I get yelled at a lot at this stuff because people naturally think it's my fault because I'm the messenger. Well, please don't shoot the messenger, okay? Trust allocations. Under our current laws, it's not really a law, but under the current situation, trust allocations are generally brought into income on December 31st. And so if I had a capital gain in a trust, a family trust before June 25th, is that going to be brought into my personal income and eligible for the $250,000 exemption on December 31st, or is it going to be pre-June 25th, right, at the 50%? We don't know. Implementation date, I think that the June 25th implementation date don't hold me to this, but if I had to put my money down, I think that they're going to kick this down to the road at the last minute, just like they've done with UHT and the trust reporting rules. I think that it is so ill-conceived that they can't possibly have this date stick. But it's entirely possible based on all the language that Chrystia Freeland and Justin Trudeau are using with regards to this policy, that they're just going to keep it going and go for it on June 25th. And I think that, frankly, they are dumb enough to let that happen. Sorry, excuse my passion over this topic. The $250,000 exemption should extend to corporations. That would create fairness, as we've discussed before. And so will they actually put in a $250,000 exemption for corporations? Or alternatively, will they get rid of it for individuals? That's a real possibility as well. What about certain types of trusts like estates, like graduated rate estates, right? Will the $250,000 exemption apply to that? Right now, the announcement seems to indicate that trusts are not going to be getting the exemption. So how's that going to work? What about grandfathering? How about for sales that took place or gains that were accrued before June 25th? Not sure. I mean, it seems that they're not going to do that, but we don't have law yet. And is this just the beginning? So is the government going to further increase capital gains rates in the future? It's entirely possible. Who knows? These are just some of the uncertainties which are giving us some heartburn and giving our clients really, really big headaches. So what are some suggestions on how to fix this mess? Well, the Joint Committee on Taxation, which is made up of CPA Canada and the Canadian Bar Association, so the country's lawyers and accountants sent their recommendations to the government. So they try to generally be collaborative with the government in advising them on the real practical issues about trying to help the government from making a really poor decision, okay? And they sent in a paper to the government on this. And among other things, they want to they said, listen, allow taxpayers a straightforward way to trigger gains on their properties without actually rushing to dispose them before June 25th. This is going to be, and incurring huge professional fees to do it. Right. So they want to extend the other recommendation is to extend the transition date to December 31st to actually give people time to review the legislation and think about how it might apply to their situation before they make a decision about triggering gains and prepaying tax. Right? Maybe allow grandfathering on certain transactions entered into before a certain date, such as if you sold your company last year, but you're still being paid over a couple of years, right? How about change the legislation to prevent retroactive effects on transactions that were entered into before June 25th? So, for example, trust transactions or capital gains reserves. So if you sold your company, but the sale date's not actually going to be effective, the closing won't be until August 1st, but you started it before that. Fixed disintegration. It's simply not fair that a company would have to pay 10 to 15% more tax on a capital gain fully distributed than an individual with the same capital gain, and then deal with the various trust issues. There's all kinds of them. So what's the status of the current legislation? Well, there isn't any. The government has put through a budget bill, and I believe that it's well along, but there's nothing in that 686-page document that talks about the capital gains exemption. And when that was released, that was only 7.5 weeks until June 25th deadline. So we can guess the outcomes of the April 16th budget announcement, but it's virtually impossible for us to provide solid advice to our clients. And so, why are they doing this? I think I hinted at this earlier. We've had 8 or 9 years of reckless spending here, and the government in their budget calculations is expecting a $5 billion tax windfall in 2024 from this policy announcement. And so that means they're expecting a bunch of people to prematurely trigger capital gains at the old rates. And they need that $5 billion because they've been spending like drunken sailors. And so this is a tax shoring up measure. Call it a wealth tax if you like. Call it whatever you want. Notwithstanding the government's spin, which is false and obviously misleading, the government's own budget shows that this is effectively a wealth tax, and it's going to be triggered in a couple of weeks. And while the stated target of these proposals are the so-called ultra wealthy and the rich, I think I've talked lots about how the small business owners at the table, probably listening to this podcast, are going to be taxed on the first dollar of capital gain, while giving the ultra wealthy a $250,000 per family member per year advantage, right? So if I'm an ultra wealthy person, good chance that I have a family trust, and perhaps, I'm earning $1 million a year in capital gains and splitting it between 4 people and not subject to these new rules. So that's just not fair. But here we are trying to raise money because we've overspent for the last several years. People are going through a world of hurt, and we need to raise tax revenue. So stick it to the rich, right? Wrong. Anyways, that's my review of the capital gains inclusion rate increase. I'm sorry I don't have more details for you. You can expect a follow-up once we do. And that's it. Thank you so much, and we'll look forward to chatting with you next time.